Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Broadcom.
If you find our talks useful, please consider subscribe, like, and comment underneath. So today we are digging into what honestly might be the quietest giant in this whole AI revolution.
Yeah, quiet is definitely the right word for it.
Right. I mean, you read the daily financial headlines,
Yeah.
and it's always the same consumer-facing apps or, the standard graphics processing unit makers grabbing all this spotlight. They're driving all this retail valuation hype.
But today we're actually looking at the underlying plumbing.
Exactly. The infrastructure. The company that's basically holding the blueprints to this. It's a staggering $630 billion big tech gold rush.
And the broader macroeconomic backdrop right now makes this specific analysis even more compelling.
Oh, absolutely. It's turbulent out there.
Very. We are seeing sudden oil price spikes, the Dow Jones skidding on inflation fears, just a general anxiety sweeping through equities. Investors are seriously worried about a tightening economy.
But then you look at Broadcom, and they're defying that macroeconomic gravity.
Rallying straight through the volatility.
Right. And it's not just some typical quarterly earnings beat driven by speculative hype or retail euphoria.
No, it signals a fundamental structural shift. It shows how the world's largest hyperscalers are actively building out their data centers right now.
And when a stock ignores macroeconomic gravity to that extent, you really have to look under the hood. I mean, investors are desperately seeking safe harbors right now.
And surprisingly enough, an AI semiconductor designer is proving to be one of those harbors.
Which sounds counterintuitive, right? But it's because of the sheer velocity of their cash generation and their firmly locked-in customer base. So let's break down these massive numbers, analyze this unique competitive moat, and figure out what this trajectory means for your broader wealth-building strategy.
It is the perfect time to dig into the fundamentals.
So let's start right at the top line. The Q1 fiscal 2026 numbers, which, just for clarity, align with the calendar year Q4 of 2025. They're just massive. Broadcom reported $19.31 billion in total revenue. Just to put that into perspective, that sails right past Wall Street consensus estimates. They were sitting at $19.21 billion.
So a solid beat.
Yeah, it represents a 29.5% year-over-year growth rate.
Which is wild.
Right. For a company of this sheer size and market footprint to grow at nearly 30%, it's like watching a massive ocean freighter accelerate like a lightweight sports car.
That requires an unbelievable amount of fundamental momentum. But the critical detail for any wealth-building analysis here is where that growth is actually concentrated.
Because it's definitely not evenly distributed.
Exactly. It's not evenly distributed across their entire portfolio at all. The market is intensely focused on their AI semiconductor solutions. And that specific segment alone reached $8.4 billion in revenue for the quarter.
And the growth rate on that specific AI segment, 106% year over year.
Doubling.
Literally doubling. Think about that dynamic. If you picture Broadcom as a massive freight train, their legacy businesses are the heavy cargo cars, just sort of steadily rolling along the tracks. But that AI semiconductor division
is the nuclear-powered engine right at the front?
Yes. Pulling the entire operation forward at breakneck speed, it is dragging the whole top line into the stratosphere.
And that high-margin engine pulling the train drastically alters their entire profitability profile. If you look at the bottom line, their adjusted earnings per share hit $2.05.
Beating the consensus of 202.
Right. But institutional investors are looking much closer at the adjusted EBITDA, which came in at a staggering $13.13 billion.
And it is the margin on that EBITDA that is truly remarkable. They reported a 68% EBITDA margin.
68%.
Basically, their pure cash profit before accounting elements like taxes and depreciation get factored in. And the operating margin itself expanded to 66.4% from the prior year.
Which is a textbook illustration of operating leverage.
Break that down for everyone.
Sure. So Broadcom has already sunk the massive multi-billion-dollar initial research and development costs into designing these incredibly complex AI chips, right?
The heavy lifting is done.
Exactly. So almost every additional chip they sell now drops straight to the bottom line as pure profit. This is the dynamic that drives durable wealth accumulation in the tech hardware space.
They aren't hiring twice as many engineers to meet twice the demand.
Or building twice as many corporate headquarters. The core intellectual property is locked in, the foundational infrastructure is established, and now they're simply cashing in on the immense scale of their operations.
That scale is precisely how you hit a 68% margin in a hardware-intensive business.
Competitors simply cannot match that profitability without an identical volume of locked-in orders to offset their own heavy R&D expenses.
Now, accounting profits are great on paper, but raw cash is what actually builds durable wealth and protects a portfolio. In Q1 alone, Broadcom generated $8 billion in free cash flow.
$8 billion in one quarter.
Right. That means 41.5% of their total revenue turned directly into free cash flow, which is actually an increase from 40.3% the previous year.
That $8 billion acts as a financial fortress against the exact macro volatility we mentioned earlier.
It creates a tremendous compounding flywheel effect. When a company generates that kind of raw, unencumbered cash, it gains strategic options that smaller, cash-strapped competitors just don't have.
Broadcom can aggressively fund robust capital returns, meaning massive share repurchases that reduce the outstanding float and consistent dividends that reward long-term shareholders.
While simultaneously pouring billions right back into aggressive AI research to widen their technological lead.
It creates an operational momentum that is incredibly difficult for rivals to disrupt.
There's another metric in the data that highlights their operational discipline perfectly, and its inventory days outstanding. It improved from 49 days down to 44 days, effectively dropping below their 5-year average.
That is a crucial metric right now.
They have safely secured $3 billion in inventory specifically to handle the upcoming AI demand, but they are turning it over hyper-efficiently. This is vital because in any booming tech sector, the biggest hidden risk is the bullwhip effect.
And the semiconductor industry is historically notorious for falling victim to the bullwhip effect during massive demand cycles.
It's essentially the corporate equivalent of what we saw at grocery stores back in 2020. Consumers panicked about potential shortages, so they bought 10 times the paper goods they actually needed.
And manufacturers saw this massive spike in orders, panicked themselves, and ran their factories 24/7 to catch up.
Exactly. And a year later, demand normalized, and everyone was sitting on huge warehouses full of excess inventory they couldn't move. In the tech world, companies see explosive AI demand, panic about supply chain bottlenecks, aggressively overorder silicon components, and eventually end up with billions of dollars of obsolete chips when the initial demand spike cools off.
But Broadcom is actively avoiding that exact trap. By securing that $3 billion in inventory, they ensure they won't suffer from crippling component shortages that would delay hyperscaler buildouts.
But by turning that inventory over in just 44 days,
it demonstrates that the product is moving from the fabrication plants directly into active data centers almost immediately. The demand is real and immediate. It's not just speculative hoarding by their customers hoping to build a safety buffer.
Turning over inventory that fast is impressive, but it doesn't entirely explain how a hardware company commands a $1.49 trillion overall market valuation. I mean, Marvell sells chips too, and they're a great company, so we have to ask what makes big tech so fiercely loyal to Broadcom specifically.
It comes down to their absolute dominance in custom silicon.
Right. Application-specific integrated circuits, or ASICs.
Yes. While a standard graphics processing unit is incredibly powerful, it's designed to do a lot of different computational tasks. It's a Swiss Army knife.
An ASIC, on the other hand, is custom designed from the molecular level to do one highly specific task with maximum power efficiency and speed.
It is a laser-guided scalpel.
And efficiency is everything when we're talking about data centers the size of football fields.
Yeah.
The major hyperscalers, specifically Alphabet, Microsoft, Amazon, and Meta, they are aggressively deploying what are known as XPUs.
These are highly customized processing units built specifically from the ground up for their own proprietary AI workloads. Broadcom holds the core proprietary intellectual property for both the intricate AI and networking protocols and these bespoke semiconductor designs.
Together, this custom silicon and networking segment makes up 65% of Broadcom's entire revenue stream.
The switching costs associated with that dynamic are astronomically high.
Big tech is currently spending a combined $630 billion on AI infrastructure. Once a hyperscaler integrates Broadcom's tailored silicon into a multi-billion-dollar data center architecture, it becomes permanently intertwined with their proprietary software stack.
You cannot simply swap out a Broadcom custom chip for a cheaper competitor's chip over a weekend to save a few dollars. Leaving Broadcom would require re-architecting their entire hardware and software ecosystem from scratch.
It's simply too expensive, too time-consuming, and entirely too risky when these tech giants are locked in a fierce arms race for AI supremacy.
Any delay in processing capabilities could cost them market share they will never get back. This deep structural dependency is their true competitive moat.
Smaller competitors might develop fantastic standalone technology, but they lack the massive IP portfolio and the deeply entrenched, co-engineered customer relationships required to displace Broadcom.
Which brings us to the forward guidance, because the market is always pricing in the future.
And the forward guidance they released for Q2 fiscal 2026 is phenomenal. They are actively projecting $22 billion in total revenue.
Which would represent a 47% year-over-year increase.
It completely obliterates the previous Wall Street consensus estimate of $20.49 billion. Within that $22 billion target, they expect AI semiconductors specifically to hit $10.7 billion.
A jaw-dropping 140% year-over-year jump.
That 140% growth figure is fueling some intense industry chatter right now.
Oh, absolutely. There are currently speculative projections floating around Wall Street suggesting Broadcom actually has the potential to reach $100 billion in annual AI chip revenue alone by the year 2027.
Now, I have to step in and play devil's advocate here, because part of smart wealth management is questioning the hype. $100 billion in a single revenue segment is a massive number historically reserved for entire sovereign economies.
It's an astronomical figure.
Given the volatile macro environment with ongoing inflation, oil spikes, and rate uncertainty, isn't there a severe risk that these major hyperscalers pull back on this massive capital expenditure before we ever hit 2027? Projections are great on a spreadsheet, but they always assume a straight line in what is fundamentally a jagged, unpredictable economy.
It is absolutely a valid skepticism. Projections stretching out to 2027 inherently carry a wide margin of error, and macroeconomic shocks can disrupt even the best-laid corporate spending plans.
Right.
However, if you carefully map out the compounding effect of that $630 billion data center build-out that is already underway, the underlying math on that $100 billion rumor actually starts to materialize.
The institutional money certainly seems to believe the pathway is highly viable.
The recent 13F filing data absolutely backs up that institutional confidence.
For anyone unfamiliar, large institutional investors, asset managers, and hedge funds are required by regulators to file 13F reports detailing their equity holdings. This gives us a transparent window into where the smart money is actively flowing.
And recent data aggregated by Whale Wisdom shows significant cluster buying.
Right. This is a specific phenomenon where multiple massive asset managers are simultaneously accumulating shares in the exact same stock.
We are seeing sustained institutional accumulation in Broadcom, signaling that Wall Street firmly believes this hyperscaler demand is durable, not just a passing phase.
Looking ahead, there is a clear catalyst calendar for investors to monitor over the coming months. First, late June 2026 is critical, as that is when the Q2 earnings will officially reveal if they actually hit that ambitious $22 billion guidance.
Second, you need to keep a close watch on major AI industry conferences, particularly the upcoming follow-ups to events like Computex.
Any public updates on those XPU production ramps with their 5 major hyperscaler customers will act as immediate market movers.
And we also have to heavily monitor the macroeconomic sector rotations. Currently, there is a visible rotation into semiconductors fueled by market expectations of upcoming interest rate cuts.
Lower borrowing costs generally favor growth and technology sectors, as it makes capital investments cheaper. Given Broadcom is guiding for 76% overall semiconductor growth, they are perfectly positioned to capture that broad macroeconomic tailwind if rates do indeed come down.
But a responsible wealth-building strategy requires looking closely at the bear case, too.
We cannot simply look at the massive growth numbers and ignore the very real geopolitical and macroeconomic risks facing the broader semiconductor industry.
The most immediate threat comes from the regulatory environment, specifically the new U.S. export rules that restrict the sale of advanced AI chips to certain international markets.
These trade policies mechanically cap international growth by explicitly cutting off massive potential overseas revenue streams.
Restricting total addressable markets is always a headwind for growth.
From a purely quantitative standpoint, these restrictions are a major factor keeping some of Broadcom's sentiment scores somewhat neutral, despite their massive earnings beats and cash flow metrics. But the crucial nuance here is how these specific export controls actually impact Broadcom relative to their global competitors.
Because while the rules do inherently limit international expansion, they inadvertently favor deeply entrenched U.S.-based market leaders.
The domestic demand, that $630 billion big tech spend we keep circling back to, is so incredibly ferocious that Broadcom has more than enough immediate domestic buyers to absorb their entire supply chain output.
Smaller international competitors, however, suffer significantly more from a fractured and heavily regulated global market, which ironically further solidifies Broadcom's domestic moat.
Then there's the broader macroeconomic volatility. The global market is dealing with serious war escalations and sudden oil price spikes, which historically compress overall enterprise spending.
If rising energy costs trigger rampant inflation and push the global economy into a severe, prolonged recession, standard enterprise software and hardware budgets will absolutely be slashed across the board.
But this is exactly where the difference between discretionary tech spending and existential tech spending becomes exceptionally clear.
Broadcom is incredibly insulated by that $8 billion in quarterly free cash flow, and they're deeply locked in hyperscaler contracts.
Big tech companies do not view this current wave of AI infrastructure as a luxury or a discretionary upgrade. They view it as an existential necessity to survive the next decade of the internet.
A company like Microsoft or Meta will cut thousands of administrative jobs, radically reduce their global marketing budgets, and slash their commercial real estate footprints long before they ever stop buying Broadcom's custom AI chips.
They simply cannot afford to lose the AI infrastructure race because the penalty for falling behind is permanent obsolescence. They are the ultimate picks and shovels provider for this modern data center gold rush.
Looking across all the fundamental data, the institutional buying patterns, and the deeply disciplined supply chain metrics, Broadcom is earning a 9 out of 10 bullish score based on our analysis today.
They are a relentless, free cash flow machine equipped with an unmatchable competitive moat built on prohibitively high switching costs. For anyone looking at the wealth-building potential in this specific sector, they present as an exceptionally strong multi-year hold.
The foundational metrics are undeniably robust, but there is a vital, lingering question that you should deeply ponder as this narrative unfolds over the next few years.
We've spent this time thoroughly analyzing the explosive 140% AI growth tied directly to hyperscalers, aggressively building out their massive custom infrastructure today. But what happens to that revenue momentum once the foundational infrastructure is actually complete?
It is the most important question in the sector. When the concrete is poured, the facilities are powered, and the servers are finally racked, does the music stop?
If we fast forward a few years, once these massive data centers are completely built and fully populated with Broadcom's custom XPUs, will the standard replacement cycle and ongoing maintenance contracts be enough to sustain these astronomical 68% margins?
Or are we currently witnessing a peak infrastructure boom that eventually, inevitably, has to plateau?
Is the fundamental difference between profiting from the massive undertaking of building the railroad versus the steady but much less explosive business of maintaining the tracks?
That is exactly the kind of critical thinking required to successfully navigate this market and build long-term wealth.
You have to look past the initial build-out, past the current hype cycle, and critically evaluate what the steady state looks like for these massive valuations. Thank you so much for joining us for this comprehensive analysis of Broadcom. Keep questioning the numbers behind the financial headlines. Stay intensely focused on identifying those durable competitive moats, and we will catch you next time on Smart Wealth with Joshua.